Okay, hi everyone. So today I'll be presenting my risk and compliance individual assignment on the global financial crisis. Okay, so in early 2007, the housing crisis actually escalated, and many banks and hedge funds that invested heavily in those subprime mortgages, they were actually left with worthless assets as foreclosures rised. So in early 2007, many subprime lenders began to file for bankruptcy. And then moving on to late 2007, around August, the losses from the subprime loan investments caused a panic that froze the global lending system. And then from March to August of 2008, the Fed Reserve actually agreed to guarantee 30 billion of Bear Stearns assets in connection with the government sponsored sale of the investment bank to JP Morgan. And Lehman Brothers' size and integration into the US economy, they actually made it a source of systematic risk. So when the firm collapsed, right, it created a lot of problems within the financial system and the economy as capital markets froze up and business and consumers, they couldn't get any loans. So then in September 2008, Lehman Brothers actually filed for bankruptcy court protection, and the American International Group, which is the world's largest insurer, they accepted an 85 billion federal bailout, which gave the government a 79.9% stake in their company. Okay, the first reason would be interest rates, because the interest rates for mortgages, they were set extremely low, and this will lead to a lower cost of borrowing that will encourage more people to lend. And another reason would be securitization, because those mortgages, they were being grouped into a new financial instrument and then sold on the secondary market as a low risk security. So these financial instruments kind of revolutionized the banking industry because it allowed banks to transform and trade an otherwise illiquid and unprofitable asset as a low risk security. And so mark-to-market accounting practices, although it's not legal, it allowed institutions to report profit on the sale of securities earlier than necessary. Okay, so the third reason is because many high-risk loans, they were being grouped together because the US government, they actually gave out mortgage guarantees. So mortgage guarantees is a type of loan in which a third party agrees to pay if the borrower should default, and in this case, the government will cover all losses. So these high-risk loans, they will then be sold to investors by the banks, sold to investors and government organizations. And another reason would be the CRA, which is the Community Reinvestment Act that was signed by the US government. It gave low-paid citizens access to mortgage loans. And so low-paid citizens are considered like high-risk borrowers. And sure enough, they were unable to clear their debt. Okay, so the fourth reason is that house prices and household debt, specifically mortgage debt, they started to rise, and this continued until the real estate bubble burst. And during the burst, the house prices, they fell, but mortgages were still like very high. So the default of mortgage repayment, they also piled up because interest rates started to increase, and unemployment rates were also at an all-time high. So many households, they were having difficulties to service their mortgages. And credit rating agencies religiously relied upon to provide credible rating of individuals. They were ineffective in providing their service, which led to the financial crisis. So these are just some statistics during the financial crisis, like housing prices fell, unemployment rate was high, how much was moved from money markets to treasury bonds, and 30 billion federal guarantee, which I mentioned earlier. Okay, now we'll move on to some of the responses from banks and regulators. Okay, so strong regulation actually had a negative impact on countries with undeveloped banking sectors, and shallow banking is actually positively associated with the consistency of bank credit provision to non-financial institutions through and beyond the financial crisis. So this indicates that one size fits all approach is not feasible, a one size fits all approach to good regulation. And ever since the global financial crisis, central banks and governments have assisted the financial sector immensely with the purpose of overcoming the crisis and to turn the economy around. So some of the responses of policymakers and regulators to the global crisis include debt guarantees, capital injections, asset purchases, and liquidity and lending provisions. So why do we need to have such regulatory responses? It's because it's meant to change a specific behavior in the market for the good of all, and only with the right volume and size of regulation, then only will we be able to achieve our desired results. However, over-regulation or under-regulation, it can pose significant problems. So it is intended that such a calamitous economic event never repeats itself again, but over time with changing environment, technology, there's of course a need to review the regulations from time to time. Okay, so some of the key reforms that have been finalized under FSB guidance and are being implemented can be summarized as these few here. So we have the adoption of Basel III capital requirements, including a counter-cyclical capital buffer and a surcharge for globally systematically important FIs. And then we also have an agreement reached on one of the two envisioned liquidity standards, which is the LCR. And there has been some progress on trying to reduce too big to fail, higher capital adequacy requirements, and also more intense supervision and some reforms of national resolution schemes like built-in instruments so that failing institutions can be resolved without wider disruptions. There has also been some enhancements to the securitization model and some closure of the data gaps, which is the beginning of harmonized collection of improved consolidated data on bilateral counterparty and credit risks of major systemic banks. And then there has also been agreement in principle on similar treatment of some types of financial transactions under the US GAAP, which is the generally accepted accounting principles, and also international financial reporting standards. So that is all for my presentation. Thank you so much.